कई सालों के बाद ऐसा हुआ है कि दुनिया की टॉप 100 कंपनियों में भारत की एक भी कंपनी शामिल नहीं।
ब्लूमबर्ग की रिपोर्ट के मुताबिक 2025 की शुरुआत तक रिलायंस इंडस्ट्रीज, एचडीएफसी बैंक और टीसीएस इस ग्लोबल लिस्ट में शामिल थी, लेकिन अब सभी बाहर हो चुकी हैं।
India has no company left in the global top 100 by market cap, and that number tells you everything about what has happened to Indian equities this year.
India just lost something massive. For the first time in years, not even a single Indian company is part of world's top 100 companies by market cap. And strangely, almost nobody's talking about it. Because on the surface, everything looks still normal. Nifty near highs, Sensex stable, people still posting buy the dip screenshots on LinkedIn like they have decoded capitalism after watching 2 finance reels. But underneath that surface, Indian equities are going through what the experts are calling the great compression. And once you understand what's happening here, you will realize this is much bigger than just stock markets. Let me try to explain what exactly is happening. See, at the start of 2025, Reliance was ranked 74th globally. Today, it slipped to 105th rank. TCS fell from 84th to 314th rank. Infosys completely dropped out of the global top 500. Even giants like LIC, ITC, Kotak and Axis Bank have been sliding continuously. Now, normally when people hear this, they assume Indian companies are failing, but not really. The problem over here is more complicated because this is happening due to 3 massive forces hitting India at the same time. First, foreign money is leaving, and not slowly. Between January and April 2026 alone, foreign investors pulled out nearly 1.9 lakh crore rupees from Indian equities. Why? Because globally money has become expensive again. US bond yields are rising sharply, and when American government bonds starts giving safer and higher returns, global investors stop taking risk in emerging markets like India. Simple logic hai. Why chase risky growth markets when you can sit comfortably in dollar assets earning solid returns? But that's only one side of the problem. The second hit came from the rupee. The rupee recently touched nearly 97 against the dollar, its weakest level ever. And this matters because global rankings are calculated in dollars, not rupees. So even if an Indian stock remains stable here domestically, globally its valuation starts looking smaller after currency conversion. मतलब कंपनी वही है, business भी वही है, but globally it suddenly start looking weaker. And then came the third blow, West Asia. The US-Iran-Israel conflict pushed crude oil prices above $100 per barrel. Now for countries that produces oil, that's great. But for India, it's a headache because we import nearly 85% of our oil. So expensive oil means higher import bills, higher inflation, more pressure on the rupee and slower corporate growth. Basically, one problem starts feeding the next, and the entire cycle started compressing valuations across Indian markets, especially sectors like IT, because now Indian IT companies are facing another issue, artificial intelligence. Companies worldwide are trying to cut outsourcing costs using AI tools, which means traditional IT services firms are suddenly facing slower demand growth, and investors are reacting accordingly. But despite all this, something very unusual happened. The Indian market did not collapse. In fact, it stayed surprisingly stable, and that's because of one major shift happening quietly in the background. Indian retail investors through SIPs, mutual funds and domestic institutions. See, Indian households are now pumping massive amounts of money into the market every single month. Monthly SIP inflows crossed 30,000 crore recently, and domestic institutions absorb almost 90% of the foreign selling pressure. Think about how insane that is for a second. A decade ago, if foreign investors sold this aggressively, Indian markets would panic instantly. Today, domestic money is acting like a shock absorber for the entire system. And honestly, that may be the biggest structural change happening in India right now. For years, Indian market depended heavily on foreign capital. Now slowly, India is learning to fund its own growth story. But transitions like this are never smooth because for years, Indian stocks traded at externally expensive valuations. Now the market is resetting itself, not collapsing, resetting. And while old giants are losing global rank, new sectors like AI, manufacturing, clean tech and healthcare are slowly attracting fresh capital. So no, this is not the end of India's growth story. It's simply the end of easy money. Let me know what you think about this in the comments down below. Thank you so much for watching. I'll see you in the next one.